before I forget. Good afternoon and welcome to this wonderful Lunch and Learn.
Where exactly do I see the transfer tool? Because I tried doing that.
If you can put yourself on mute if you're not, unless you're about to ask a question. I will try and mute as many people as I can.
My product?
My name is not Charlotte Connell. It's actually, my name is not Climate Salad. It's actually Charlotte Connell. Gosh, we're off to a great start.
There's a manage.
And I'm just going to mute Rajata and anyone else who isn't on mute yet. For this Lunch and Learn session, we are joined by the incredible Nicole Small from Start Small Ventures. And as you know, it's to VC or not to VC. There are many different pathways to funding, which Nicole will go through with you. But before I get started and hand over the virtual mic to Nicole, I'd like to acknowledge the traditional owners of the land of which we meet. For me, that's the Gubbi Gubbi people, Wanya Nullam, and I honour their elders past, present, and joining us on the call today, and honour their continuous connection to country, land, and sea, the oldest continuous culture on this planet. And there is so much to learn in climate and sustainability from them. So I am going to hand over to you, Nicole.
Thanks, Charlotte. Excited to see so many people join. I'm going to share my screen and then start to jump in. So there we go, and presentation mode often works best. Great. I'll just pull up just setting up my screen so I can see everyone. Cool. So as Charlotte mentioned, my name is Nicole Small. I'm the founder of Start Small Ventures, which is a consulting firm providing a support to startups around growth strategies and capital strategies, as well as to investors looking to invest in early stage businesses. Really excited to be here and chat about a topic that I'm really passionate about, and not many people sort of talk about this, whether VC is actually the right strategy for many people. VC is often seen in the startup world as the one and the only source of capital, but it's actually not. And very few companies actually meet the criteria for VCs. And unfortunately, many climate tech companies at this stage in Australia don't meet the mandates for VCs as well. So I'll get into that, and I'll get into sort of some explanation as why, and then talk to, well, what are the other sources of capital that you can access, and where, how to assess what the right source is of capital, what the right timing is for you, how much to raise, things like that. I'm also very comfortable to make this an interactive session. I find it works a lot better when everyone sort of raises their hand and asks questions as the material comes up. There's a lot of material that I can cover, but really want to make it relevant to you guys, the audience. So please do raise your hand or write in the chat bot if there is questions, but I'll also try and leave a bit of time at the end for questions as well. So yeah, don't be shy. I think I've sort of talked through a little bit about what I'm going to talk to today. Just a little bit about me. So my background, a lot of people ask me how I got into sort of investing in startups. So I spent 4 years working, most recent 4 years working at Rampersand, an early stage technology startup, predominantly sort of out of Melbourne. It was not a climate focused startup, and we looked at climate investments, but there was a lot of challenges with them. So that sort of led me to sort of step away from that and look at doing my own thing and sort of leaning into where I'm passionate about. To get there, I sort of took a sort of a roundabout way to approach that. So came from investment banking early on in my career, so I have some good skills around understanding financial analysis, financial models, actually how businesses sort of make money, which is actually interesting in the VC world. Making money is being profitable is often not the goal. It's about top line growth. And then I moved into strategy consulting. And probably sort of where I cut my teeth around technology is working in SEEK's strategy team for 7 years. So that got me great exposure to understanding disruptive technologies and emerging innovations that can disrupt different industries and businesses, as well as working very closely with the product and development teams to build products that solve customer problems. So that's me. And so, as I said, I worked for 4 years at Rampersand. So I guess where my experience and expertise come, and this is probably relevant to today, is my experience is really around early stage startups and the VC landscape funding those startups. I've looked at thousands of pitch decks, invested millions into the ecosystem, and supported a number of great founders building quite disruptive businesses as well. I guess, you know, the few to call out is GoTerra is one of our portfolio companies, which is really exciting, and sort of happy to talk about that because it sort of breaks the mold for the rest of the portfolio. And it probably does for, if you look at most of the VCs in Australia, that type of business definitely sort of breaks the mold. So before we get started, just so I know most people's screens are off, but really sort of want to understand who here is looking to raise capital sometime in the future. You can just either signal a hand on your thing, or great. We've got a few people who've checked and got a sort of thumbs up. Perfect. Sounds good. Okay. Great to know. And who out of this group is looking for particularly VC funding? Not sure. A few people not sure. A few people yes, but a few people not sure. Cool. That sounds good. All right. Well, given there's not too many sort of who are really looking for that VC funding, might sort of cover this VC 101, what VCs are looking for. Just quickly, I think it's worthwhile to understand the VC mindset particularly. Some of it is relevant to what all investors are looking for, but particularly sort of to understand, well, is VC right for me or not? It's really worthwhile. So there's a lot of misunderstanding of what a VC is. And so I'll just go through some of the basics, which is the job of a VC is they actually raise capital. They raise capital from external investors. They're called limited partners or LPs. And so as a VC, they also have to go on that sort of pounding the pavement, knocking on investors' doors and trying to raise the capital. So they do understand as a VC, often, particularly the partners, do understand how difficult it is to raise capital and how intimidating, challenging some of the conversations can be. So they do sort of sit in the founder's shoes in that way. Once they've raised capital, they then have the ability to invest that capital. So that's where they're looking to invest in different startups. And from that investment, what they're looking to do is, of all the startups that they invest in on a portfolio level, they're looking to deliver over 3 times return on the capital, including fees and everything, which actually equates to they have to average about a 4 times return on all investments, across all investments, to return the sort of capital sort of that investors are looking for. And so it may seem like, okay, that's not such a big, turning $1 into $3, that's okay, but it's actually really hard. And I'll explain why it's hard, particularly in startups, in the coming slides. So venture capital is super high risk, but it's super high return. So by that, it means there's a very high chance that you're going to return nothing. But if you do return money, you can return really, really big returns. So Canva is the best example of that, in that, hey, they've made their investors a lot of money. It's poor language, but they've made a lot of people very, very wealthy. but they're sort of one out of very few companies that have made such returns. A lot of returns, and probably Milk Run is probably the most public and recent one is, they actually return nothing to their investors. So that's the vast majority, although the papers acted like, oh, it's just Milk Run was that anomaly. It's actually the norm. And if you actually have a look at this slide, it shows that about 65% of venture-backed startups are going to return less than the capital invested. Is really like what we sort of expect as a venture capital. So that means to return that 3 times, including fees, back to investors, we've got to make VCs have to make all their money from only 35% of the companies that they invest in. So, the sort of law of sort of weighted averages, you've got to have some big outcomes to offset all those losses. And so that's where the challenge around VCs comes from. And that's why VCs have such strange sort of investment mandates and what they define as what good looks like, because they're really, you're looking for companies that are going to grow really, really fast, with the potential you're going to lose a lot, but the ones that come off are going to come off big. So you're really looking at what's called is a power law distribution, not a normal distribution. So VCs invest based on 1, or if they're lucky, 2 companies in the portfolio are really going to pay off. They're going to be like a Canva-like return, and the rest are going to go to 0. And that's how VCs invest. And that's probably a bit how VCs manage their portfolio as well. So if you're in that sort of group or in the bucket that is seen to have the potential to be that one in the portfolio to return the fund, you'll get a bit more time from your VC investor. If you're in the bucket or the bigger bucket, that's probably not going to return anything. You won't get too much time from your VC investor. And so that's how sort of the VC market plays out. And that's how VCs think about their business. It just also might stop here. Is there any sort of questions on this? If not, I'll move on.
Oh, sorry, Nicole, there was a question in the chat about what the percentage of those being SaaS or hardware, like typically the breakup, like if it gets into that. And that's, I mean, like some VC firms specialize in software and some in hardware. So, but if you can best answer that, Nicole.
Yeah, so I don't have any stats on that. I think in the past sort of 5 years, particularly in Australia, the vast majority are software-based businesses. So if you look at the sort of well-known VCs, the vast majority will be software-based businesses only. And that's one of the reasons why I say the sort of traditional VC model may not be right for climate tech startups, because VCs typically don't like hardware or infrastructure or products. And so while, climate tech software companies have a role to play, they probably are not the majority of what the climate tech, startups need to be to really change our carbon footprint. So, unfortunately, VCs aren't the sort of more traditional VCs in Australia aren't going to invest there. Australian VCs, and this might be a bit controversial, but in my view, are a little bit vanilla. They're looking for sort of really sort of quite a narrow mandate. That may change in this current sort of economic landscape where investors start to look at becoming a bit more specialized or looking at sort of outside just traditional VC mandates. But for the past 5 years, that's definitely been the trend of really quite narrow narrow mandates that back really very software-based businesses that can grow really fast globally. And Australia, there hasn't been sort of the competition around capital or anything for the VC world to be super innovative, and they've done really well. VCs have, for the past 5 years, have done really well with the mandates they've had. So there's been no pressure to expand that. I think what will happen sort of in the next, 2 to 3 years, hopefully will change that and make VCs or investors look more broadly and look at different opportunities. And I mean, I'm sort of definitely on that pathway around, okay, software-based startups are great and they can deliver good returns to investors. But if we want to solve the climate challenge, which is a huge opportunity in the market, we need to think about different ways of investing and different mandates of what good looks like. So, hopefully there's sort of some new funds or people that sort of start to come up in the market and look at things differently.
I know you'll go into like debt funding and different avenues, like sort of hardware might have their sweet spot. There are a few questions in the chat just on this sort of hardware software, but I did want to ask, because Rampersad does specialize in more software, but then you did back GoTerra. So what is it about a hardware company that would make a traditional software VC go, we'll back you?
Yeah, so GoTerra was actually invested before my time. So over 5 years ago, 5.5 years ago now, was the first investment that Rampersad made into GoTerra. So the challenge there is I'm not sure exactly what the discussion was around the table. But I think it was, at the time, it was really, GoTerra had a really particularly 5.5 years ago, Olympia was at the forefront of using black soldier flies to solve the organic waste problem. Now, I know there's, in these 5.5 years, there's a number of competitors and other solutions out there, but 5.5 years ago, she was really leading in her solution, and the way she was looking to build the business model was quite unique and quite scalable. And so I think the team looked at the market opportunity and the sort of unique IP that she had built and thought this was really, really interesting. I think some of the lessons that have been learned from that is it's actually, while GoTerra and Olympia are brilliant, and, can't speak highly enough about Olympia and what she's built. From Rampersad's point of view, we did definitely sort of follow on and participate in follow-on rounds. So, Rampersad has a great position within GoTerra. But when other companies came up and sort of with similar models, there was challenges that we learned around the GoTerra model that sort of translated to sort of a reluctance to invest in others that had similar or sort of similarities around the business model. So I think in future, I think there will be, it's a really hard question to answer around sort of, I think the lesson learned from Rampersad's perspective is they'll probably sort of avoid similar investments. I think where things will change is once there is actually case studies to show the return that you can generate from investing in these companies, I think that will start to change the VC mandate, the VC mindset. VCs, while they're looking to back innovation and disruption and take on risk, they like to pattern match against what has looked like in the past. So once you have other startups that deliver great returns that VCs can pattern match against, I think that will change some of the tide around, actually you can make good money. This is how you do it. And therefore we will open up our mandates. That's my belief. So I think that's sort of one thing. And then I think it's the other thing is VCs or investors starting to realise the opportunity that investing in climate provides. So both of those, I think, will start to unlock capital for climate tech startups that have a non-traditional or sort of non-software, pure software business model. Hope that answers it. So yeah, sort of talked a little bit of that, which is this slide here, which is really what are VCs looking for? Companies that can grow to big companies really, really fast. And I sort of made a bit of a joke that I don't know if anyone else got, which is VCs are looking really for top line growth. So when we say big companies fast, it's really about revenue growth. For the past sort of 4 years, up until mid last year, it was definitely only top line growth that VCs were looking for, was all revenue, nothing below the revenue line. Now VCs have sort of changed their tact and are starting to look for slightly more sustainable businesses, but still top line growth is probably the key metric that VCs are looking for. So I think I've also sort of talked a little bit about this, which is actually what do VCs like and what do VCs don't like? So, as I've mentioned, VCs like sort of pure software businesses. And the reason for that is they often have very low marginal costs. So the cost to bring on new customers is minimal because you just sort of open a new license and, customer instance and there you go. You don't have much cost. Whereas if you've got hardware, for example, in GoTerra's situation, every time they brought on a new customer, they had to issue a new what's called a MIB, which is the mobile unit, consumption unit that sits. It sits at the site of where the organic waste is produced, and they have to sort of put in all the robotics and everything. So there was a marginal cost of, a couple of $100,000 or so each time they brought on a new customer. Whereas when you've got software, it's just, add on a new customer. So that's the difference. VCs love B2B. They don't love direct to consumer or business to consumer models because it's hard, particularly in Australia, it's hard to build the scale you need in the consumer market. And B2B are often more sophisticated investors, probably slightly longer sales time, but you can charge higher sort of price points. They like global, so a lot of VCs talk about global from day one. So particularly in Australia, the Australian market is pretty small. So you either have to be in a very, very large market to be only Australia based. Otherwise, VCs are really looking for you to go global. And, how do you do that from Australia? It's also harder to do that when you've got a product or hardware as well. Software is easier or is thought of as easier to get a sort of a global solution from Australia. So that's sort of another challenge around having hardware. VCs love massive markets. So often VCs will say, oh, the market's too small. So that talks to the sort of the end game opportunity. They love highly defensible businesses. So I think that's where sort of GoTerra had some wins in that there was some real unique IP around their business and capability. So it was seen as more defensible than others. Fast inflection of growth, which again talks to like really fast growing. And they like industries that adopt innovation. So one of the things relevant to the climate space is, I've seen a lot of climate businesses, providing solutions to farmers and to agriculture, and that's notoriously bad and slow for adopting new technologies, and also hard to get low cost of acquisition and sort of build your market. And so often those type of companies struggle to get funding because VCs in the past, VC-backed companies haven't done well in those markets. And so that's another challenge for climate, where you're sort of working with farmers, agriculture, energy, big energy producers, where you're working with the energy utilities, and they're slow moving, they're sort of reluctant to adopt innovation. Those type of things scare VCs off. And they don't want to invest where they're concerned, hey, traction's not going to come quickly. You've got to be very patient. Capital, you probably need to be, the companies are probably quite capital intensive until they get to scale, and then there's a big opportunity. But until you hit that inflection point, it can be a hard road. And so that's where VCs don't love that. And VCs love companies, startups that are accessing data. AI is the future. So sort of, I think any startup needs to be thinking about their data strategy. So a lot of these I've sort of covered around what VCs don't love. Then the last one, which is sort of non-commercial founders. One of the things VCs often look for is really the founder and the founder capability. And so often founders coming from more of a deep tech background lack that commercial sales ability. And that doesn't sort of, it may be an incorrect assumption that VCs are looking for, because they'll pattern match around what great founders of past companies look like and try and match them against, the company in front of them. So I blame a little bit of the lack of funding flowing to women founders is because the pattern match is often a male founder, and so women present a bit differently. Again, also sort of migrant founders often sort of don't pattern match against sort of the traditional founder either. So some of these things may not be fair, but really that's how VCs work. And until someone builds a sort of better AI tool that sort of is able to assess a founder's capability without sort of implicit bias, then we're going to sort of have to work in this under some of these sort of constraints. So that's sort of what VCs do and do like. Now, sorry, I actually can't see the chat here because I've got, is there any questions that are coming through?
A few came through. They're loving the slides, and if we can definitely have them shared afterwards. But yeah, sort of agreeing with that hardware. So I guess those, like, other than VC, how do we get hardware funded? Which I'm sure you'll be covering in the next few slides.
Yeah, I hope so. Yeah, not sure. But anyway, I'll talk about the other sources of funding, and then we can sort of talk through, well, how do you get hardware funding? And I've got some thoughts on that, which may not have drawn up some slides, but I think there's sort of, for me, there's something around, this is sort of an area that I'm trying to lean into and work with a couple of groups around, or what does it in, with hardware, how do you create an investment mandate that could invest in hardware, and what are the financial products that you can build? And they might be sort of a little bit different to what we've seen in the past. So that's sort of where I'm personally sort of quite passionate about and leaning in. I haven't covered that here today because it's still pretty early and haven't got any products in the market yet. But there, I think there's some room for some innovation. And there's an article that I think it's called CTE VC put out recently that actually sort of talks to different ways in which investors may need to start looking at how different ways or different products in which investors can look at funding hardware and infrastructure, and taking models that have really come out of like project finance and helping sort of provide the right risk return trade-offs to investors for these type of investments. So that's like something interesting. So I can share that after. So just on the sort of other sources of funding. So I've labelled it as dilutive and non-dilutive capital. So by that, I mean dilutive is where investors take a part of your equity. So you won't own 100% of your company, you give up some equity for capital in your business. And non-dilutive is where the investors will give you capital in another form, but doesn't actually take any equity in return for that capital. They'll ask for returns in different ways. So for non-dilutive capital, you get to, the benefits are you get to retain all of your business. So you remain in full control of your business. You can grow at a comfortable pace. You can do what you want. You're not sort of accountable to other people to some extent. The drawbacks are often you've got less capital to fuel your growth. And, you know, you may have to take some lower salaries or pay, you know, your staff more in equity rather than just pure salaries to begin with. Dilutive capital is you can grow faster if you can acquire enough. So that's important in competitive markets, and often, you know, I would say look at VC funding if you're operating in a competitive market, or sort of look at sort of probably dilutive capital if you're looking to enter a competitive market where capital is going to help determine who's going to be the winner. So sometimes the access to capital can be the competitive advantage in different industries. So, for example, I know I've talked about this, but Milk Run, really, it was, you know, their access to capital or lack of access to capital that meant that they couldn't win. If they could still access capital, there was an opportunity to actually then win the market. So when they got funded with Volley and the others, it was really who could raise the most to then win out on, you know, marketing and just running at a loss. With sort of dilutive capital, you can get, you know, faster product development. You can, some of the sort of less capital related benefits are actually, like if you get a VC or if you get a strategic partner investing, you access their advisor and support networks. Now you can build this without capital, but if other people are incentivized in the success of your business, you may get them more engaged in supporting you and opening up their network and offering different advice. So that can be really valuable. And you get accountability. I know I sort of put it as a pro when you don't have any, when you don't have anyone in your cap table, you have little accountability. I actually think sometimes it's worthwhile having others who you have to report to and share with, because it means you're getting that feedback. You've got someone who's not looking over your shoulder, but really sort of aligned with the success of your business and wants you to do the right things. So it can be a benefit. Con, there's less equity for yourself, but if you're looking to grow the pie, that you shouldn't sort of constrain yourself there. It should be, when you're looking for dilutive capital, it's about, I want to grow the pie. And so if I've got less percentage, but I've really grown the pie, I end up with more eventually. And then around the con, again, it's sort of the expectation to grow fast or to deliver returns to investors in the time frame that they want rather than your time frame. I think that's sort of a big sort of challenge around taking on external capital. So what are sort of the different sources? Like non-dilutive, I've sort of talked to bootstrapping, and I'm sure a lot of founders are sort of well aware of what bootstrapping is. It's really, you know, reinvesting the profits into your business, and, you know, and if you don't have profits, sort of investing your personal cash back into the business as well, and growing like that. And there's been some great success stories of founders who have done that, but it's challenging. And it's challenging when you've got sort of high upfront costs to do that, you know, consistently. strategic partnerships, so like partnering with strategic partners and asking them to bring on, like, pay sort of upfront for the services and then delivering out the services over time. That can be really powerful in helping to sort of bring on revenue upfront. It's, you know, if you can do it, it's great, but it's not easy to often get those partnerships and those agreements. But it's definitely something worth trying to. Grants, you know, there's lots of grants out there. There's lots of grants for climate investments. There's lots of grants for particularly women founded businesses. It does take a lot of time, but like, have a look at Grant Guru. It's a website which you can sort of source some. Victoria, I'm based in Victoria, so I know there's sort of a number of the grants here, but there's been some really interesting grants that have come up more recently. There's one around the circular economy that's, I think, looking to put up to about $1 million into businesses. So there's really sort of a whole lot of different grants that you can access. So it's worthwhile sort of investing time to look at what they could be and then applying, which is can be a bit of a headache, but can be worthwhile. Revenue-based financing, so similar to Tractor Ventures, which is if you've got revenues of a certain point, you can get financing based on your revenue, so you don't have to be profitable. It is expensive, but some founders say it helps them unlock growth in the early stages of their business. So, you know, I think, you know, just go in understanding about the sort of the cost of that, but it does provide you some access to capital to achieve certain milestones early on. And similar, it's quite similar to that, which is just credit. So like using, like if you get some bank credit cards, often, you know, in you know, founder war stories, you'll hear people, you know, using their personal finances and credit. Look, I think just be careful with that, because, you know, if you're sort of like family, your house, you know, your mortgage is on the line here, just be cautious with taking on this type of debt product. But it is also another avenue. Dilutive capital. So I actually might move in here. So dilutive capital investors. So there is family and friends, which is lovely, and everyone sort of laughs when I say this, because, you know, there's not many people who have hugely wealthy family and friends who can fund their businesses and help that. But, you know, F&F is a you know, a strategy that some investors use. I think angels is really probably where you should sort of start with. You know, family and friends, it's great if they've got the capability, but they often don't understand the risk that they're taking on. And if you lose your family's money, you know, the family sort of relationships can be difficult, whereas angels are more aware. And so where do you find the angels? It's really challenging. There's a number of syndicates, angel syndicate models that are doing that, investing. There's a number of sort of climate focused angel groups. Have a look at Aussie Angels. They have a few listed on their platform. The other angels and even sort of other sort of investors is, I've left off actually sort of angels, high net worth individuals here, family offices, actually, it's another one. Angels are sort of high net worth and family offices where they are aligned with what you're building. So if they've got like a climate thematic around their family office, or, you know, are leaning into the, like, there's angels on the Climate Salad Network and community, where they're leaning in, you know, reach out to them. But I think the other thing is where you've got sort of like if you're operating in an industry. So, for example, I'm helping advise a company to raise capital in the packaging industry. They've got some innovation around sheep wool. So, and they're looking to build a facility around the Geelong area. So if I think about them, it's what angel networks or high net worth individuals can we tap into? So there is Geelong investors who are interested in building out the sort of Geelong economy, and so would invest in something that aligns with that. Investors with people who've made money from sheep farming, so who are looking at innovation and revenue growth opportunities for sort of sheep farming, may be interested. Their product is really relevant for the food industry and the pharma industry, so tapping into those networks. So you can often be quite creative around how to target different investors that are going to meet, that are going to see alignment with what you're trying to build and their strategic objectives, you know, beyond just being an investor. And so I think really sort of think outside the box and how you tap into that network pool. Venture capital, so I've talked about that and about some of the challenges, particularly around climate. And corporates is another one where you can tap into as well. So where a corporate is aligned with what you're doing and can support you, it can be worthwhile looking at them to become an investor. A few cautions there is make sure they're not going to restrict your ability to build the product that you want. So sometimes corporates, and I saw this at Seek, is they would invest in a company and they'd have their own strategic objective of why they invested in that company. If the company didn't meet that strategic objective, they would really try and shift the strategy to meet Seek's strategic objective. And so that was limiting the potential growth of the broader business to just plug the hole for Seek. So we're taking on strategic investments, just be conscious of that. So hope I'm not speaking out of school, but sort of Seek had invested in GoOne, and quite early on, GoOne was really good at saying, yes, that's your objective, Seek, but this is where we're going to go. And they built a very, multi-billion-dollar business by doing that. Another example is a sort of more temp labour force. The name has left me, which is now 100% owned by Seek. And so they've done very well as the founders, but they haven't built a unicorn business. So, there's different benefits, but you just have to be aware of what, of taking on sort of more corporate money and what paths that can lead you down. The other thing is crowdfunding can be another interesting capital raise strategy, particularly for direct-to-consumer brands or brands that are going to have, a whole lot of customers or like SME customers, where you've got a whole lot of customers who are really in love with your product, who can be your product ambassadors, and you can give them a bit of a sort of equity, so they're incentivized to go and share it with all their friends. It can be a great strategy, but it can also be challenging to get some of the crowdfunding. In my view, it's more direct-to-consumer businesses that do well on the crowdfunding platforms. And finally, venture credit, which sort of straddles both dilutive and non-dilutive capital. They're often looking for later stage investment. They could be a good investment vehicle for hardware businesses. So they'll provide debt on your sort of hardware products, and they can be both a debt product, but they can also take some equity or put some warrants in there that convert to equity, so they get the upside. So depending on sort of the product that you're looking at. Other sort of groups sort of around sort of the credit the sort of debt is like actually taking R&D. There's a lot of R&D debt providers that will provide you the debt upfront based on sort of your R&D, like tax concessions and things like that often sort of come in later, so you can bring that upfront, but there's a high cost to that as well. So those are sort of some other sort of financial products that you can use to fund more hardware like opportunities in the early stages. And once you're past this sort of some early stages, you can then get sort of bank funding as well. But this is sort of like what I'm talking about is probably pre-bank funding opportunities. Any questions? Jump in.
Hi, Nicole. There's quite a few questions and wonderful commentary in the chat. And we have about 15 minutes left. So for those who've been commenting and asking questions in the chat, would you like to come off mic and ask, Nicole?
Well, did I just, oh, no, we'll just.
Oh,
Well,
go to what you have next.
Oh, there's lots of questions. Sorry. Yep. So is anyone sort of, anyone keen to jump in?
And some great resources put up there too, which was great to see.
Awesome.
I think, and we can even go back to those sort of like hardware ones. Oh, Sam, you go.
Well, one slightly indirect question. How would VCs feel about contingent purchase orders? So it's not revenue-based financing, but in terms of trying to demonstrate early traction, if I was to get someone to say, I'll buy your, because we're hardware, we're reinventing air conditioning. If I was to get someone to say, yes, we'll buy your air conditioning system, you know, provided that it can, you know, when you test it, it will tick this box or whatever, but here's a purchase order. I mean, is that something that would be a very tangible thing that would be viewed quite well, or it doesn't really de-risk it enough?
I think like it, you know, it is helpful if you can get that, but it doesn't, it's probably not tangible enough to de-risk it enough. VCs see, so I think the challenge there is VCs see a lot of deals and sort of follow startups over time. And the challenge there is each startup comes and says, look at our pipeline of potential customers. You know, you just have to invest, because if you don't in the next 3 months, you know, our revenues are going to shoot up to over $1 million or over $2 million in ARR. And so, you know, you've got to invest now. What happens is, you know, 12 months time, actually, that pipeline hasn't converted as the founder has hoped for. You know, founders are often sort of, I think part of the challenge is they've got a natural optimism. So they're always like, oh, look at my big pipeline, it's all going to convert. And it doesn't play out like that. And so VCs have been burnt a lot by seeing that. And so investing on what the client says they'll do versus what they actually put their money to is very different. And so it can be helpful, particularly in markets where it's really slow and hard and there's a lot of, you know, research and deep tech. But the vast majority of VCs will say that's like, we want to see actual customers signed up and paying.
Yeah.
So yeah, I think it's challenging. I think there is potentially a way to say, traditionally, sort of, I haven't loved like tranche investment rounds where you like stage the investment to say, hey, you know, you take a small payment now, and then once you've delivered on an agreed to milestone, then you know, unlock additional capital. But maybe for, you know, I think we have to be a bit creative and different with climate tech hardware businesses, and so maybe a product like that starts to get some more traction. And I think Main Sequence does sometimes helps to create sort of funding tools like that for some of their more deep tech founders. So, you know, utilizing that to say, well, we've got these signed up, you access a little bit of capital once you've actually then built the next iteration of product or demonstration, then you can access, you know, more capital. And so that can potentially work, but that's generally not what VCs are willing to do. Traditional VCs are willing to do, unfortunately. Tim?
Hey, Nicole, thanks for sharing your time and experience with us. My question is a bit of a nexus question. So those working in climate tech, and Charlotte, you've heard this question before, and I know Stefan has as well, and I'll carry on asking it until we get the answers to it, really. we're kind of unique in we're working at the nexus of those things that generate emissions and causing problems, and therefore an opportunity for this market, and those that the funders or the VCs or the investment community are willing to support. Last year in climate tech, about $70 billion went into this space. 75% of it supporting energy and mobility kind of projects, which only really account for 27% of emissions. So that we have a big challenge in that the time frame is non-negotiable. The opportunity is there, but the funding streams are, with the economic cycle we're in at the moment, slowing down a bit. So I'm just wondering what kind of meta, kind of high level observations you've got of you've gone through many of the other sources of funding, but this is becoming an acute challenge right now.
Yeah, look, as I said, unfortunately, I don't have the answers. I guess acutely aware of those challenges, and like that's where sort of I'm passionate about helping to solve for it. But it's really challenging, and I think I wonder if I've got a view. I'm probably not the sort of foremost sort of expert on it though. But my view is I think government have a big role to play here. You see what's happened in the US and some of the incentives there around sort of unlocking investment. So that's one thing. But I think also the other point that government has is actually really pricing carbon so that it sort of creates sort of it changes the economic or sort of like the business case for different projects for different businesses, and really sort of prices in the costs that actually emissions is going to cause. And someone put up on the Climate Salad community, I don't know, the last day or two, an article that talks about how much subsidies are actually flowing to fossil fuel. And it's just like actually like should be complete opposite. So that's sort of my sort of thing around government, and I'm sure everyone here agrees, and probably has more sort of more wisdom to share there. But then in terms of the investors, I think sort of speeding up some of that sort of returns that early climate tech companies have delivered. So if we can speed up the sort of the outcomes and sort of demonstrate the business case of some great climate tech investments, I think that will help unlock some capital. I think there is, and then sort of finally, I think there's a lot of sort of philanthropic money that is looking for a home around climate. And I would sort of say, how do we sort of funnel that into sort of more of an investment case and sort of really focusing on areas that are really going to move the needle, rather than have sort of just more like, okay, I'll donate X amount and not expect a return. How do we sort of actually, because I think that's a bit of the challenge with climate. When I've gone out to speak with different people in the last 6 months, it's like, oh yeah, that's a philanthropic or that's a philanthropic investment. It's actually, no, there's a financial return here. And so I think accessing that money will hopefully then kickstart some things, and then more sort of financial return money will also start looking for a home within climate. Yeah.
And I think we might have time for just Kirk's question. He's the only one raising a hand at the moment, which is good, unless anyone wants to sneak one in, but Kirk.
Hi there, I'll defer to anybody else if you want, because there's more of a statement. I was going to supply some answers that you've just provided. Thanks, Nicole. So yeah, I agree in reverse order. The philanthropic pathway is important and increasingly available. I think Australian philanthropists are waking up to this opportunity and the importance of investing quickly. The whole philosophy around philanthropic investment is changing significantly. It's no longer the case that you want your investment, you want your capital to last for 20 years and just live off the returns of that. Whilst it's invested in potentially questionable industries, they're shifting their capital directly to the industries that can have an impact on the problem. The Australian Environmental Grant Makers Network is having a conference at the same time as the Smart Energy Council next week on the 3rd and 4th. So everybody should keep an eye on the outcomes for that. And then I agree, yes, government has a huge role. What we're seeing is really in relation to the difference between SaaS investments and energy and hardware investments is a tragedy of the commons. Carbon is not appropriately valued. So we're not seeing the return on investment for these initiatives that we should be. And I think, we are, as you said, seeing governments come to the party on that. The other one was just a thought for Sam, which because we're operating at Supercharge Australia across the lithium value chain, we just completed our first cohort in an innovation challenge a couple of weeks ago. But because we're across that value chain, we kind of start at the mining end of lithium and go all the way through to the circular economy of batteries and recycling and so on. And an interesting insight from the way mining works, and it's a startup industry like anything else. It's just been around for a lot longer and has its own sources of finance in Australia. But you'll be reading accounts of offtakes occurring. So as you go downstream from the raw material, the battery makers and the car makers are making what's called an offtake investment, where they'll actually provide an investment to the miner in return for a guaranteed supply of the material. So it's a way that the mine can be brought forward. And I think, again, this is, not a very well-defined thought, but I think we need to start considering that, and might be worthwhile for you, Sam, when you're talking about forward orders being a source of value for your company. See if you can convince them to make an offtake investment where they're actually prepared to stump up some money for the first round of product. And like I say, I think because there's a history of that, particularly in Australia in the mining community, then that might be something we can start to get some traction on, because there's just no way to bring these hardware solutions to market unless we bring that capital forward somehow. And as Nicole's rightly said, VCs aren't in that game. So that's what I wanted to say. The question is not anything other than yeah, it's just a big statement. Thank you.
I'll say that comment or a statement. Thank you so much, Nicole. That really does wrap it up, but we definitely need to have some more of our hardware heroes because climate tech, hardware is hard, deep tech takes time, but these are must-have solutions, not nice-to-haves. So we got to, and as Tim alluded to, and we hear it all the time, we don't have time. We have to get this going. Thank you so much for joining us for this Lunch and Learn. Nicole, thank you. It's always a pleasure to dive into your brain. Just give us, and to give that landscape of the different avenues to funding and what works best. So this is a constantly evolving conversation, and what works for one startup doesn't necessarily work for you, because it's a time and a place thing too, like this we're explaining with GoTerra, with hardware. And but thank you everyone for joining us. We will, this is recorded and we will post it in our Slack channel and onto our YouTube channel as well. Thank you so much, Nicole.
Thanks, guys.
How can we reach you, Nicole? If anyone has questions.
Sure. So
I mean, you are in Slack, but
yeah, so I'm on the Slack, I'm on the sort of community. I've got a that doesn't actually help, but yeah, so if you look me up on sort of LinkedIn, Nicole Clyde Small, Twitter, I'm not very active, Nicole Clyde, or nicole@startsmallventures.com.
Wonderful. Thank you so much, and we'll talk to you soon.
Thanks, guys.